Hello, I'm Asif Farouk of Finextra and I'm here with Nicole Anderson of Simulocity. Nicole, thank you for joining us.
Thank you.
So, should banks be using more real-world simulations to address issues such as liquidity management in stress scenarios?
Asif, absolutely. You know, the world is changing. The world of liquidity and, you know, is now such a topical issue. Liquidity is a flow, and the way in which it's currently managed and has been historically is being incredibly siloed. Systems, structures, processes are all, you know, deal with current state. What simulation allows for is to kind of draw the future into the current state, mold that with business critical variables, and still address the unpredictable potential future variables such as, you know, counterparty risk, exposure to financial markets, and of course, you know, looking at all the new requirements coming down from a regulatory perspective.
What problems do you think banks can address through exploring this approach?
Well, first of all, being able to be in a position to really be decisive about how they react to what is growing pressure around compliancy. I mean, that's top of mind, that's drawing down resources, and the pressure is immense, we all know that. However, what is really interesting in the world we're in now is that they very often being compliant and actually being competitive are two conversations that never happen together. You know, what simulation allows for is actually to kind of bring those two topics together quite nicely. And so being able to address things like market competitiveness, because, you know, having insight now on collateral usage and collateral efficiency is so much more of a reality, and simulation really does allow for that.
And how are simulations beneficial to banks?
Well, you know, being able to first of all understand what variables are coming down the line, for example, from exposures to their community, their ecosystem, whether that be upstream or downstream, would be incredibly useful. The counterparty risk, you know, the whole shadow banking world is incredibly important for a bank, right, to operate. No bank operates in a vacuum. Upstream, of course, being able to serve their customers better is hugely important. And we know our banking customers tell us that their own ability to really differentiate when it comes to offering liquidity solutions is incredibly tough. And predominantly that's because their attention and their resources are focused around being compliant. If they knew where the liquidity gaps are and where the liquidity opportunities could be, they could pass on that opportunity to their customers and therefore actually serve that whole ecosystem far better. So simulation really does infuse the entire financial supply chain with more freedom to move. And as I said, liquidity is a flow.